You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. Well, we got a special treat for you. This was a Saturday Night Live skit back from 1978 with the incomparable Dan Aykroyd.
Inflation is our friend. For example, consider this. In the year 2000, if current trends continue, average blue-collar annual wage in this country will be $568,000. What this inflated world of the future will mean. Most Americans will be millionaires. Everyone will feel like a big shot. Wouldn't you like to own a $4,000 suit and smoke a $75 cigar, drive a $600,000 car? I know I would.
All right. Well, with us now is David M. Stryzewski. We're talking about inflation, stagflation, Fed out of control, rate increases, too little, too late. David, it's great to have you back. So we were playing a clip from Dan Aykroyd in the heyday of Saturday Night Live. It was actually back from 1978, I believe. Yeah, October 1978. So almost exactly 44 years. And, well, inflation didn't quite work out the way Jimmy Carter expected. We didn't all become millionaires, but we got a lot closer to it. And now it looks like the current occupant wants all of us to be millionaires, right?
I guess that that's the case because a lot of what policy has been doing is actually making inflation worse. And so, if the goal is everyone becomes a millionaire at the exact same time, then I guess the new reality is that we all need to become billionaires in order to still be able to afford life. So it's really awesome to be with you here today, Carrie, and just even to have that clip to start us out. I hadn't heard that one before, but how interesting to hear ideas like that.
Hey, well, we might, just remember in Zimbabwe, everyone was a trillionaire there too, and they couldn't afford a loaf of bread. But I always like to say, I'm enjoying inflation. I think it's an incredible experience because I've never made more money in my life. I can't afford to do anything. I can't afford to go out, go to restaurants. So I'm saving more money than I ever did in my life. And pretty soon I'm going to be a millionaire, David. So I should be happy, right?
Hey, there it is, Carrie. You solving all of life's problems. No, the consumer is 70% of our economy today. So if we get the consumer right, and that's really the sentiment, then that's actually what's going to be driving where we go next. But I'm very concerned today. Just kind of with the tongue-in-cheek talk that we're doing. It's very concerning today to understand where we are in history. I love to be able to reflect where we've been. We just played an awesome tape that helps us to understand where we are today, and then gives us projections of where we might be going for the future. So we can measure a distance when we have 2 points. And so, here we had 41 and a half years where the Federal Reserve has ultimately been able to reduce interest rates in a meaningful way. And 41 and a half years, though, that's called a full and complete cycle. And so I've been talking about this and been very clear for several years now about how the Fed cannot continue to reduce rates like this. Additionally, we understand inflation comes from where? Comes from spending. I think a lot of people, though, ask the question, hey, how did we get to inflation this time, but maybe coming out of 2008, we did not see inflation when quantitative easing 1, 2, and 3 went in place, where we were printing essentially $80-some billion monthly for the span of almost 3 years. So why didn't we see it back then? Well, why we didn't see it back then specifically was that those dollars went into the banks. Part of the Dodd-Frank Act was to bolster up the account balances of banks, who we found out were actually keeping very little of our deposits, and they were lending it out in the form of all these mortgages that got, obviously in big trouble there in 2008. So we didn't necessarily see inflation everywhere, although we did see inflation in three specific categories, real estate being the first category. We saw, since 2010, just prices go skyrocketing, which is amazing. I've done very well as a result of some of that, and I'm sure many have as well. More millionaires have been made actually in real estate than any other industry. The second thing that we saw inflation in was college education, and so when the government says, "Hey, we'll insure this, we'll give you these government loans, just keep going deeper and deeper and deeper, get the education," we saw the rates on that go higher and higher, and then the third place is in our medical costs. Now, inflation is rampant. The difference now is that these dollars actually got out into society. We held rates down for too long. We had PPP stimulus money when everything shut down. And then in March of 21, we had this second round of dollars that came in with the Biden administration kind of making, their first declaration and act. And honestly, that's been the big catalyst of why inflation went through the roof, in conjunction with the Biden administration's fossil-free agenda to not have U.S. oil be continuing to be produced at the volumes that it was, and obviously our positions on Keystone Pipeline, refineries, et cetera, and that's led us into the place where we are today. So the consumer's suffering. It's a very, very, very tough time, and we've got these supply and demand imbalances here. And I'll just say this last point, and that is, if the Fed only affects demand, they can only bring down demand. When they raise rates, the whole goal is that you can borrow less, that you, the consumer, has less money and purchasing power. Inflation's taking your purchasing power away, but the Fed's actually trying to diminish your ability to buy stuff with the money that you've still retained. So as an example, even if you can get 4% on your bond yield in treasuries, if inflation's at 8% or 9% right now, you're still losing at 4 or 5% before taxes. And so that's an actual loss of capital. And so we're in a time frame now where it's really important that we're paying attention to what is changing, why it's changing, and having an understanding for, again, where have we been, where are we today, and where might we be going? I mean, hey, it'll never happen again is the favorite, this time it's different. Those are some of the most famous last words here that consistently find themselves into the narratives, and I'm not buying it.
Well, the last person who told me this time would be different is my ex-wife. So
okay.
Right? I mean, get serious here. How many times are you going to fall for this garbage? Right?
Right. Exactly. So, I think one of the most important things that we're not looking at today is specifically unit demand. See, when we price a stock, we look at the cost of that stock, and then we look at the earnings. And Robert Schiller has given us some excellent work with his CAPE ratio, et cetera. But the point is that analysts today are looking at earnings and they're saying, well, hey, companies are making almost the same amount as they were the year before, or et cetera. And the reason for that is because the price of everything is so much higher. If you look at earnings on an inflation adjusted basis, tell me what looks good right now. There's not a lot. And
energy is the only thing, and it's been highly volatile, but I think that's about it, right?
That is about it. And I think that it's going to continue to be volatile. Obviously, what's going on in Europe and the fact that, our nation is even experiencing a diesel shortage. We have serious energy needs. And in fact, I'll make an important statement here, and that is that what we're going through right now with inflation and supply demand imbalances has never been about demand. This has always been a supply crisis. It was always about the supply of energy not being there, the supply or the amount of houses that we don't have to buy into. That's what caused the price go up. So if the buyers want to buy more and the sellers want to sell, the price goes up, especially if the interest rates stay low.
Yeah. And that ain't rocket surgery, right?
It ain't rocket science, brain, whatever. Yeah. So, but no, we obviously saw the Fed now raise about 4% here in the last 8 months, essentially doubled the mortgage rates, and that's a really, really, really big challenge here as we look at things. So it ultimately comes down to supply and demand. The Federal Reserve only affects demand, and then the question is, who affects supply? And so that can be the president, Congress, et cetera. And right now they're not doing that. As far as supply goes, well, we need more energy. And so we shut down the Keystone Pipeline. We stopped new fracking, permissions to go and explore. We have a housing crisis. We don't have enough houses out here today to be able to live in or even rent. And so, of course, supply and demand dictates if the buyers want to buy more and the sellers want to sell, the price goes up. Well, when we get into talking about what's taking place, the Federal Reserve has raised interest rates about 4% in the last 8 months. So as far as mortgage rates go, that doubled what mortgages cost. Now, I don't know about you, but did you get double the income here over the last 2 years? I certainly have not. And I don't think most people got salary raises at 50% or whatever. The point is that the buyers today are in a difficult place because they just can't afford to get into something new, especially with the price of everything going up. The owners who have owned these houses for 20, 30 years, a lot of the families that I work with, they're saying, shoot, I was planning on moving to Florida or moving someplace else. And oh my goodness, I'm in this amazing 3% mortgage rate, but I'd have to buy in at a 7+ mortgage rate if I move. And I'm having to sell in that market. So we're kind of like have this golden handcuffs here that we've got these really low cost rates. And so I think that that's actually going to cause the migration challenges that we've been, or the changes that we've been seeing over the last 2 years to actually really slow down. Because we've been seeing tons of that. If it's difficult to find more places to live, we're not gonna see that change as much. Although those who have owned places for a longer amount of time do have Section 121 exemptions to consider for tax purposes when they sell. But it's only going to come down to when they want to move or refi a property that these rates are going to matter. Now, the builders are one I want to mention here. The builders are in a very difficult place today. Why is that? Because it's been the most expensive time to acquire property to build. It's been a very difficult time to acquire the assets being, the windows and doors and all the wood and everything in between that's going to help to make this house. They've got employees that are more expensive than ever. And guess what?
Right.
They are now not able to really sell because the prices for those properties have become very difficult to meet, even with those that had letters that said, hey, we're approved and we got mutual, but the place didn't get built. And so we need more supply. And I'm very concerned that builders are going to have financial troubles here and may or may not be able to survive, at least as well, because a lot of their liquidity or profits are going to be dissolved here. The other part to this is as we look at corporations, Carrie, we have to understand that these corporations are borrowing. Right. So in order to continue to grow as an organization, you need to borrow to buy more trucks and buy more materials or whatever it might be. Well, a lot of these organizations got real comfortable, including the junk bonds, which are the high yield companies. Give me 2 seconds to talk about this because we have not actually understood, I believe, what the time bond is sitting here. So if junk was borrowing at 4% and now it has to borrow at 9%, that is a completely different world. We're talking billions and billions. It's completely a paradigm shift. So here's the question: who owns these junk bonds? By and large, pension companies.
Yeah, insurance companies, the usual suckers that Wall Street unloads their garbage on, right?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
That's it. And so I believe it's going to be the American consumer that's, again, going to be feeling the pain of this. See, as a pension fund, you have to manage money based upon what a return expectation is.
Mm-hmm.
Has nothing to do with risk. If you can do it with low risk and hit that return, perfect. If you have to do it with high risk to hit that return, that's your mandate.
Sure.
The number is 8%. And so we're in big trouble right now because pensions are underfunded by $6.7 trillion nationally here. 6.7 trillion. And Carrie, I'm a personal believer that we're going to have a double dip recession, meaning we've already seen one half of it, which was the price side of things that got adjusted. Now we're about to see the earnings side of things get adjusted here. And that's what the next crisis is about. As that unfolds, and I think that it's very likely to see another 30 to 50% down, depending on the investments that we're talking about here. But for many of these pensions, we're talking that's like a 13 to 15 trillion dollar deficit if they lose even more and they have to invest this high risk. So as a nation that does 30 trillion in GDP and we're the biggest, how do you bail out 15 trillion? That is impossible. And so I personally believe that is the unexpected thing that is going to be the heavy weight that takes us into the next big challenge. Think about New York, New Jersey, Illinois, California, these high income tax states that are also high pension states. New York, by the way, is the biggest one in deficit, and more people moved from New York. So I think April 15th this next year, we got tax day showing up, and more 1%ers find themselves in a southern state with no income tax or a lot lower income tax. Mm-hmm. And I think that these states are going to be facing some financial burdens that I think they should have anticipated. I think we should have been prepared for, but it's going to come all as a big surprise. So 2023, buckle up. It is not going to be an exciting year, at least as far as making money goes in the markets going and returning positively.
Hey, in depressed markets, depressions, recessions, you make money by not losing it,
right?
Or losing as little as possible. That's the definition of a winner. Hey, if the market's going up 25% a year and you only go up 10, you're a loser. But if the market's going down 25% and you stayed even or even made a little bit more because you bought some tips and you almost kept up with inflation, you're a huge winner, because when this ends, and it will end, things might be completely different when it does, David. The system might be different, but it will end. And then you're going to be in the position of having cash and being able to, enjoy the fruits of your thrift, of your using your brain when others were using their emotions.
Well, when everything goes on sale, that's absolutely the moment that we need dry powder and to be able to reallocate back in. Now, the question is, between now and that moment of time when it occurs, what do we do? Where do we go? And so I've got a book coming out here at the end of the year called Riding Bulls and Taming Bears. And so the goal is to get 70 to 80% of the gain while missing 70 to 80% of the pain. There's no way to avoid all pain in all areas if you're actually going to be making money. I will share with you one important revelation and understanding here, and that is that hedging is known as taking a long position, meaning I'm for something, but then also being able to have some defense in the event that it doesn't work out well. Now, hedging is very complex, can be very challenging to do, and to be very candid with you, it's not something that most financial advisors are offering as strategic allocations. I have portfolios today that in 2008 returned double digits positive. So you can actually even make money in down markets. You just have to know where to go. Are metals going to be in favor? Is something going to trend from cyclically, like oil goes in favor, then it's out of favor, but then it's back in favor again? Or maybe housing is horrible, but then it really starts rising. So to be able to allocate and understand that, on my watch here today, I've got a shorthand, a minute hand, I've got an hour hand, a minute hand, and a second hand. Now, neither one of these three are right. Neither one of these three are wrong. They tell me where I'm at in a day, an hour, and in a minute. And so we have to look at how we manage money in this type of worldview as well. In the short term, what's our move? Midterm, long term. So right now, no one has a long term. If someone says they have a long term, those are the people that are on margin. Those are the people that are going to be wiped out, and they are going to lose big time based on what you just shared there. In the world of riding bulls and taming bears, it's very important for us to understand where are we investing. So I've created a little methodology, and so I say learn the colors of money or remember CPR. And CPR stands for cash, protected assets, or risk assets. There's three types of assets out there: cash assets, protected assets, risk assets. And so there's multiple variations within each of these categories. I want to focus for a minute on protected assets, because there's a lot of people today that say, I'm afraid of the macroeconomics. I'm afraid of some of the things that you just said being, coming true. And so I need protection today. So most people that say they need protection and they go to their normal advisor, the advisor goes, okay, be a conservative investor. Do 20% stocks and 80% bonds or cash. Now, that is a very common answer. One thing we need to know about bonds, though, is that bonds can lose money in 5 different ways. 5 different ways that bonds lose money.
Only 5.
Only 5. Well, I've named 5, but one of the big ones here is the seesaw effect. So when interest rates rise, the value of our bonds go down. That's why everyone's portfolios are down this year on the safe stuff.
They're shot.
And so this protected asset has got big challenges to it. By the way, if we start having corporations having credit crises and you go from A-rated to junk rated, that's going to be a big change in the value of those bonds. And if companies go out of business, you get zero back. And so that's actually a lot more risk than people think that they're taking. But I want to note, I discovered something unique, and that is there is an asset class in the protected category that has the ability to give you reasonable rates of return when the market goes up, but perfect defense of the downside of zero when the market goes down. And it's something called a fixed indexed annuity. Now, these fixed index annuities, specifically with a growth orientation to them, not specifically for income purposes, but for a growth orientation, have the ability to give you upsides that I've actually never seen in my entire, career here being an advisor.
You're a young one.
Well, that's true, but I can share with you that they only started in 1995. But for those who have done the research on them and looked at how these particular types of accounts have worked, they work well when markets are going up, when markets are going down, when markets are going sideways. The difference is they just give us a little bit more certainty. And I've personally never seen a better time to specifically own them or look at them than right now. And if I had an XY chart here looking at the efficient frontier, this is one of the things that I teach in my classes, is that the efficient frontier or modern portfolio theory is the old way of doing money management. It's the old way. Because see, when you can utilize an asset class that doesn't follow the exact same rules, that asset class has the ability to not, to ride bulls and to tame bears. What happens is you can actually reduce risk and increase return. And you should see money managers' eyes light up when I show them how to allocate some of their bond portfolio to the fixed index annuity, how it improves the overall outcome, and then how I'm not the only one saying this. Here's all the other people have been saying it. Holy smokes, why didn't we see this before? And so it's a really important thing to be paying attention to right now, because we need to be able to get reasonable rates of return. And the downside of the unprotected assets is that they have less liquidity. Mm-hmm. And in those types of accounts, expect to get like 10% liquidity. Most people aren't trying to spend all their money in 10 years. So 10% might be okay. But I like the idea of, let's say that the market was down 20 or 30% over the next 12. Well, what if we could just take 10% out and reallocate into the bottom, into the market when the market's down? We have the opportunity to make some if it made. That's the time to do it. And so it gives us the ability to dollar cost average again in retirement. And so that's a very important revelation for us to be able to have, because that's been the way that we've really made money our entire lives, is through dollar cost averaging, because no one knows when the bottom is. No one knows when the top is. We have to manage these time frames. So short term, we're seeing a little bit of a relief rally, I think we could say. Maybe it's relief that, it's not just all Democrat controlled. It looks like the House is going to get some of that. Will we get the Senate? I don't know, man. It's a very interesting day to think about, that we're here, and we still don't have election results. I just don't know how we've been doing it since the 70s when, with that piece played here earlier in the in our talk, and how we don't understand that.
Generally, man progresses and things move on, but not everything. Some things do get worse over time. and hopefully then they'll get better at another time. Look, we've seen this stuff before. There's nothing new under the sun. That was said thousands of years ago. And I guess, hey, if you can stay even and if you can make a couple bucks, if things get worse, then you're golden. And I know, David, people are going to want to connect with you, going to want to get your book. How do you connect with people on the web here?
Our website is myspg.com. Sound Planning Group. Go on myspg.com. You can see, other things that I've done in the media. I've got courses. I just finished out for the year. I've got to focus on getting this book just right. And then we're going to have a lot of webinars and such coming out here the first part of next year. But we are nationwide, though our headquarters here is in Kirkland, Washington.
Okay, well, one thing good, even though you haven't lived through inflation before, David, is that because you're younger, you're more open to alternative investments. You know that life doesn't begin and end on Wall Street. And that is something very important for you to keep track of, because Wall Street is like your no good uncle who always is driving a Mercedes, has a huge house, wearing the latest Rolex that's worth $50K, and you're trying to figure out how he does it without realizing that his clients are paying for it. And if you're a client of his, you're going to pay for his lifestyle. So I think that's an important thing to realize here. Hope you guys enjoyed the beginning of the show, that little clip from Saturday Night Live. It's one of my favorites, personal favorites. And now it's one of David's too. If you got a question, David, just shoot me an email, kl@kerrylutz.com. Don't forget, sign up for your free newsletter at financialsurvivalnetwork.com. David, thank you so much for coming on again. Always a pleasure. We'll talk to you in the next month to 2 months, okay?
Looking forward to it, Kerry. Take care.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.